Bookkeeping starts with one decision before any software opens, and the decision is what counts as revenue and what counts as expense. The two methods produce the same annual total for a solo coach, so this is not a tax optimization call. It is a management clarity call, and it gets answered once and then held year over year. Two ways to keep score. Cash. Money in is revenue when the transaction happens. Money out is expense when the transaction happens. Accrual. Revenue when earned, expense when incurred, regardless of when cash moves. The difference shows up in monthly P&Ls, not in the annual total. December 31st, both methods produce the same number for a service business with no inventory. Cash basis matches the bank statement line for line, which means a solo coach can run books at low overhead with no special judgment about timing. The default for solo coaches: money received equals revenue that period, bill paid equals expense that period. The IRS cash method gross receipts limits rarely bind a solo coaching practice, and an annual refresh on the threshold is the only maintenance the choice needs. Accrual basis records revenue when the session happens and expense when incurred. The monthly P&L stops being lumpy and starts being a truer monthly picture of what the practice actually earned in March. The cost is more bookkeeping work to maintain: accounts receivable, deferred revenue, expenses booked against the month they were incurred. More entries, more reconciliation, more discipline. Most coaches start on cash because low transaction volume, no inventory, and simple receivables fit the method. IRS cash method gross receipts limits rarely bind a solo coaching practice. The threshold gets an inflation refresh annually, and it stays comfortably above what a solo book runs. For the small fraction of coaches whose practice patterns make cash misleading, accrual is the next conversation. Accrual earns its keep in two situations. Multi-month prepaid packages. You want to see true monthly performance, not the lump that lands in the bank one Tuesday in January. Corporate contracts with net 30 invoicing. Receivables tracking is hard on cash because the money moves on a different rhythm than the work. For everyone else, the monthly distortion under cash is small enough that the simpler method tells you what you need. Here is why the choice actually matters. Same engagement, two different stories about the business. Under cash, January looks like a blockbuster month and February through June look dead, even though you delivered 6 sessions across those months. Under accrual, every month reads true to the work. If you ever try to read seasonality off a cash basis P&L, you are reading your invoice timing, not your delivery rhythm. Make the call now. Pick one. Set it in the software. Tell your CPA on first engagement. Switching mid-year creates reconciliation work you don't want. And an audit trail question I would rather not have to answer. The IRS allows changes via Form 3115, but in practice the choice is binding once made. Get it right at first software setup. One concrete exercise before you move on. Take your last 90 days, plot when the money landed in the bank against when the sessions actually got delivered. If those two graphs look the same, cash is fine and accrual would just be friction. If they diverge by even a couple of weeks, you are looking at months on the books that are not really telling you what happened.